Good morning, everyone. Thanks for joining. I think this is the second of this event this morning, so well done if you've joined for a second time. I've got Marcus Firemudge, who I think joined the TR Property Management team. I'm going to say 1997 and let him confirm. Yeah, he's nodding his head. I think 1997. So he and I have both got a 30-year anniversary in the city coming up next year, I think that means. TR Property, 16 years of dividend growth, and I think 14 of the last 15 years of outperformance, depending on whether you care about decimal points or not, one of those years. And the property sector is a really interesting place to be for income investors and total return investors, but often it's hard to know which is the right one to buy. And almost always the answer is TR Property should be part of that because it provides pan-European exposure with a heavy exposure to the home market, the UK, which is a very well understood real estate market, and TR Property also has a market cap close to £1 billion. It's part of the FTSE 250, so it ticks all the boxes in terms of liquidity and cost base and all of the things that investors place importance on. So a really interesting time, obviously, with government bond yields likely to be moving around. One suspects in the next few weeks to think about property, and so Marcus is going to speak for about 20 to 30 minutes on the trust, and then there'll be an opportunity for you to ask questions. Please do put questions in the Q&A box. You can find that by clicking in the bottom right hand corner, and I'll be looking at those questions while Marcus is speaking, and there'll be about 15 or 20 minutes at the end for me to go through some of those. So please do add your questions and we'll get to those. With that said, Marcus, I'm going to hand over to you.
Alan, thank you very much. And good morning, everybody. And I hope wherever you are, you're not too warm. You found a cool spot to listen to me bang on for half an hour or so. So first of all, to those who have listened to me before, apologies. There will be a little bit of a recap in places, but plenty of new information, and more importantly, plenty of time to ask questions. So just to remind everybody, TR Property is managed by Thames River Capital. We are a specialist real estate equity house, although we have some physical property as well. We are now part of Columbia Threadneedle. It's a 50-50 joint venture. TR is our mothership, but around that we have another 9 separate funds. So TR is about half of our assets under management, but crucially, there's a lot more people than me, full team. There's 12 of us in the UK, plus Brent Dilts who we share in the US with the wider Columbia group. Obviously, that US element is not part of the TR Property mandate. Many of these faces will be familiar. Lots of people have been with me for a very long time, which I'm very proud of, and it's an important part. George Gay, who looks after our physical real estate, has now been with me for 20 years. Joe Elliott, my finance director, 21. Alban Honor, the deputy fund manager, he's up to 17, etc., etc. So, longevity and that ability to work together over long periods of time through lots of different market cycles, really, really important. Okay, performance. Need to update this slide. It's now 14 out of 15 years, although as Alan referenced, in fact, we were only very, very slightly ahead of the benchmark in the year to March 26. So not a vintage year from relative point of view, but still, just a squeak ahead. But that long-term track record in place. So pulling together a few numbers. Again, apologies to those of you who know us well. Net assets 1.1, market cap about $1 billion. We're trading today at a discount of just a little over 9%, bit wider than we would hope for, but there may be, there are obvious headwinds in terms of the attraction of the asset class versus others, but I think those are very much likely to weaken in the forthcoming months, and I'll explain more about that as we go through. We can own physical real estate up to 15%. That's currently just coming off a all-time low, which was about 5. We're up to about 6.7%. We've acquired a building recently outside Cambridge, and I'll come on to that a bit later. And the potential to gear, very important. We're currently at 17.6% gearing. Now, please bear in mind that our actual maximum 25, but I'm unlikely to go over 20. And I would remind you that in Q2 2008, so the quarter before Lehman's went bust, we had 2 funds that we were running here at Thames River, TR Property and also Property Growth and Income, our hybrid vehicle. Both those funds were holding 20% cash at the time. So maximum bearish, 20% cash, maximum bullish, 20% geared. And today we're up here. So we are very much putting our money where our mouth is. Performance, full year results to the end of March. We've touched on briefly, share price total return slightly ahead of the NAV, discount narrowed slightly in that period. And obviously, comprehensive report and accounts has now been published, includes quite a lot in the manager's report, chairman's statement, outlook, etc., which is there for you to view as well. And then some numbers to the end of May. Obviously, we saw a sharp recovery in markets in April, then a little bit of a give back in May, and we sort of bounced around a little bit weaker, slightly weaker in June, month to date, but all potentially set to change fairly quickly if the Straits of Hormuz reopen properly, etc. Now, dividend, as Alan referenced, very important. At the end of the day, income is the underpin of real estate and real estate equities. We accept that we are at the value end of the equity trade. We're not your super sexy growth tech. We are very much the steady eddy part of the ballast of your portfolio. That's how we like to view it. But the other way of looking at it is we are the growth end of the bond trade, i.e. we're offering you high levels of income, but income that grows. And I think that's very important when you're comparing. Some people like to look at us against fixed income or against infrastructure, etc. And as you can see, our 10-year compound annualized growth has been 7%, and we have grown that dividend every year bar one when it was flat in 2009-10. Earnings per share still a little bit behind dividend, but we deliberately have reserves. The board holds revenue reserves, which we dip into when we need to, if we're still recovering from the dramatic change in interest rates from a couple of years ago. We had companies that slowed their dividend growth. We feel we're very much through that and we're back rebuilding it. But the chairman's been very clear. She wants to maintain dividend growth, and earnings will go through a cycle of earnings, and we'll rebuild those reserves when we have excess revenue, and then dip into them when we don't. So now just to touch a bit again, for those of you will have seen some of these slides before, but I just like to give the sort of underpins for real estate. And on the left hand slide, which is the bar chart with the blue and the yellow, what this is showing you is total return split into income and capital for MSCI, the old IPD. So this is physical commercial property in the UK, going back to when I started my career in 1990, as a junior surveyor at Knight Frank and Rutley with a lot more hair and a lot less knowledge. But anyway, that was where that goes all the way back to when I started. Oh, it goes beyond that, actually. It goes into the 90s, into the 80s. But the point here is that the bull market of the late 80s led to a very dramatic correction in the early 90s, so 1990 through to 94, where essentially we were dealing with oversupply from the boom of the late 80s. And that was very, very detrimental for real estate. If anything, real estate has essentially suffers from two diseases. One of them is oversupply, because you can't take that oversupply, put it on a ship and sell it somewhere else, because these buildings are stuck. It's not like flogging t-shirts where you send them somewhere else in the world. And therefore it was a long period of negative capital return as we absorbed that oversupply, and rents fell during that period. Then of course you had the GFC, and more recently the post-COVID period, where you had a very dramatic change in the cost of capital. Real estate is a leveraged asset class. Now, of course, what happened in the GFC wasn't only a change in the cost of capital, it was also a complete lack of availability. Very dramatic consequences of that, which we all dearly hope we won't be repeating. More recently, we've had this dramatic change in the cost of capital, but the availability has been there all the way along. I mean, it really has, and that's been very important. Has led to much shallower correction in returns. On the right-hand side, again, this is UK data, but it just really highlights rather neatly what has happened in those three major asset classes, although we now invest in many others as well, which we'll talk about a bit later on. But it just, none of this will be news to you. Industrial and logistics very much boomed, both, even prior to COVID, as we were moving particularly from retailing via shopping centres to omni-channel retailing, home delivery, etc., via the internet. And then office markets, it looks like a steady recovery, but that is very much been in prime locations, not in secondary markets at all. But again, I'm sure we'll have some questions on that later. And then turning to, that's the underlying market where we actually now have very little oversupply. And we've got rental growth coming through in so many of our sectors, and I will expand on that a bit later. But crucially, we have the absolute opposite of what we had in the early 90s. The early 90s, that consequence of the overconstruction of the late 80s was to do with really all about debt availability and money being provided. And the same thing happened, prior to the GFC. Really banks lending money without enough consideration. And post the GFC, we've had very, very little of that. In fact, incredibly hard to borrow money to fund a speculative development. So it's all been on pre-lets or funded through sovereign wealth, public property companies, other forms of finance. But as a result, we have so many of our markets where there just isn't enough new kit, and tenants are prepared to pay more and more to get hold of it. So more of that a bit later. Now, this slide then just basically flips the telescope round the other way in some respects and has a look at how real estate is being perceived by equity market investors when they come to look at buying real estate through the equity market. And the first point is, as I said, we are very much seen as, the cautious Cuthbert. We're at the value end of the equity trade. We are 1.4% of the all share. When you look at MSCI Global, we're about 1.5%. So we're a tiny part of the equity market, and very much discounted by many potential investors. And as a result, we're sort of at the moment a bit unloved. People associate real estate, if interest rates are rising, or if the curve isn't dropping off at the long end of the curve, then don't talk to me about real estate. It's a leveraged asset class. But I would say investors are missing three things. The first is the fundamental point, which is that we really are heading into a phase of sort of almost rude health in terms of this lack of supply coming through in so many of our markets. Secondly, we are an unloved asset class, and you can see through these numbers the scale of the discounts to asset value. Now, you for those of you who heard me before, you need to have a certain amount of respect for asset values, which are, of course, backward-looking appraisals, and real market pricing generally tends to be in flat markets a bit behind the curve. It's only in and therefore it's possible that a lot of these numbers predate the war. But having said that, the stock market saying, well, not only are we discounting that, but and a whole lot more. And then when you look at the long-term history on the right-hand side of the average weighted discount to NAV across Europe, you can see we're very much down in the cheapest quartile when you look at it over history. And this surprises me, not only because the fundamentals are looking fine, but because of the other critical factor. Oh, sorry, we're actually missing a slide in here, which is, sorry, to talk about the stabilized debt costs. Apologies for that. There should be a slide in here which basically shows the Z spreads. So this is really about the margin and the spreads on either public debt or private lending to listed property companies. And whilst we've seen the cost of money rise, and the short end of the curve sort of, we were having been pricing in, you know, 4 months ago, expectations of further short end rate cuts. Now we're expecting, one increase in the UK, and the long end has been rather stable. But in fact, what's really interesting is the margins and the spreads have continued to compress. So whilst the overall cost has therefore gone up, it hasn't gone up as much as one would expect it to. I'm sorry that slide's missing, but it's quite an important point to make. And that's something that I consider to be another sort of inverse of the canary in the coal mine. It's a sign of health in the market, and the fact that there is plenty of lending out there for real estate. And then when we look at the fact that we are owning our exposure through the listed market primarily, of course, what's happening out there is that with all these stocks trading on these very wide discounts to asset value, these very high implied earnings yields, it is no surprise that we are getting either private equity on the right-hand side or consolidation on the left-hand side is coming into our market. And anything in bold, we have a large ownership of, or had a large ownership of, and we've been very much involved in, certainly in many of these smaller situations. We've been heavily involved in helping companies, particularly ones that we want to consolidate. The problem for sub 500 million cap property companies is that the traditional owners, the wealth managers, are finding it struggling to justify owning large positions in very small companies. I mean, for many of these mega merged managers, the most recent one obviously being Rathbones Investec. I mean, to own 10, 15, 20% of a 500 million market cap company, that's 100 million quid. It's just doesn't touch the side. So you can see why many of these have been abandoned, and we need to bring them together, amalgamate them. But importantly, that will deliver efficiencies, because the operating costs of so much of this is fixed, and you can just bolt on more assets. Then you'll have companies that other listed companies just don't want to own, don't want the assets, and then you tend to see those being taken out privately. Good examples are recently were Warehouse REIT on the right hand side, which we owned only in the 3 months prior to takeout. We didn't think it was a well-run business, but when it became clear that the board were essentially doing the right thing, then we took a position later on. Okay, quickly on to exposure. As Alan referenced, we are sort of 2/3 Europe, a third UK, split between UK equities and a little bit of direct property. And then on the right hand side, by country, I don't consider that, we don't, there are certain sectors you want to own in France and certain sectors you don't. The same applies to each country. So it's actually not the actual country exposure is an output, not an input. What's much more important is this is the way we look at the world. And this is, as you can see on the left-hand side, these are absolute weightings. And on the right-hand side, they're weighting relative to the benchmark. And I think it's important just that you can see that in some cases, industrials, we look at it pan-Europe. Residential in Germany is a very particular market. You've got to have that's its own particular market because of the way that rents are so heavily regulated, and it's quite a big market. Shopping centres, we divide that between Europe and the UK, and then within the UK, we separate London from the rest of the UK because London is almost entirely sort of tourist driven, both domestic and international. But we separate UK retail from European retail, really all to do with the percentage of online sales. So in the UK, we're at kind of over a third now of all sales ex food and fuel online, whereas somewhere like Italy is still down at sort of 14-15%. So there's a very different dynamic on demand in those particular markets. And then on the right hand side, you can see our positions relative to the benchmark. Now, a lot of this has been written about in the annual report. This presentation will be available, so I am going to gloss past this just because it's, we could talk about it for hours, but you may have questions later or come back to another point. Biggest positions, I think it is worth touching on these relative again to the benchmark. TAG, this is a German residential business, but it has 25, nearly 30% of its assets in Poland, which has been a kind of almost an economic miracle, doing extremely well. They've just carved out, they had a house builder, which they owned which they owned called Robig, and that has been partially floated. It's a live situation. I think they've announced the price, middle of the range, books fully covered, etc., all good. So that's a good endorsement of that business. Picton, I'm sure we'll have questions on this. We're in the middle of what I hope will be a successful conclusion to some M&A, but I can talk about that a bit later. Argan is a French logistics business, really good, family controlled. They've owned about the Long family own about 52-53% of it. They're very good at what they do. What they're not good at is banging the drum and their investor relations, etc., etc. So this thing trades on an amazing earnings yield, about 200 basis points wider than all its competitors. And we are very, very happy owners of that. Phoenix Spree Deutschland, this is Berlin flats, but the company is in runoff, has an NAV in sterling of about £2.50, share price about £1.70. We're going to get our first 10% of our capital back in the middle of July, and essentially we're going to get they're going to give us 10% of your shares back. That accounts for only 7.5% of the assets because they are trading at such a large discount to asset value. So that's great. And then Unibail Rodamco, biggest shopping center owner, 25% of his assets on the west coast of the United States, and America, whether we like it or not, is going gangbusters. On the short side, you can see Vonovia is our biggest one, or not actual shorts, are underweight. And they are a very large German residential business, but they've really, they bought another competitor at the height of the market in 2021, and they're essentially still paying the price. Okay, and then you'll see we are underweight Landsec and British Land because we have significant overweights elsewhere in the UK. Okay, so finally, before we get on to a bit of Q&A, what have we been busy up to? We have bought some SEGRO. It is a very large underweight, but we've been busy buying SEGRO because the share price really had fallen from £14 to 7 over 3 years. We felt it was too cheap. Sargax and Catena, again, industrials in Sweden, which has done well. We bought back into Switzerland in the turmoil of March and April. Again, Swiss safety. These names tend to do very well in periods of geopolitical uncertainty. Data centers. We believe that our companies that we're invested in the case of Merlin, SEGRO, and Tritax, will all be able to make money out of data centers, but because these are pre-let. So this is not a bet on whether they how much of the data center market is going to get built. This is just, we're investing in the ones that are being built. That's the important difference. And then the UK majors, you can see the arrows on the left, up and down. We've been in and out of these, taking advantage of moments of weakness. And then the same with the residential. One that we have reloaded on in February was IRES. This is Irish residential. Ireland had put in place in 2018 a cap on rents in Dublin. You couldn't grow rents more than 4% per annum, and that was because rents were running away. There's a serious shortage of supply, lots of job growth in the tech sector, lots of highly paid jobs, and as a result, exactly what happens when you over-regulate rental markets. Developers stop building. They're like, why would I do this? I'm going to build a product that I can then restrict it as to what I can charge on rent. So I'll just wait, and eventually there'll be people will wake up to the fact that this is a really bad idea because you're not actually achieving what you want to achieve, which is getting more flats built. And the Irish government to be very sensible and realise that is the case. So they have partially reversed this decision. So now, if you are an incumbent tenant, you still benefit from the regulation, but when the flat becomes empty, the new tenant that comes in an open market rent with open market reviews. And then a bit of profit taking in European shopping centres, UK diversified, London metric. Stock was trading at a premium to asset value. We're now probably buying back into that. And then Unite, this has been our complete bet noir in the back end of 25 and into 26. And I would encourage you to read the statement in the annual report. Very disappointed. Never seen a company announce a profit warning and an acquisition in the same fortnight. They acquired a post-grad business called Empiric. Share price totally collapsed. But really very disappointing. We managed to get out of a lot of our holding at a much higher price. So I'm happy with that. But it's been disappointing to say the least. Okay, 6% of our portfolios in physical assets. As you could see, retail, warehousing, industrial, absolute at the heart of it. Wandsworth, Ferrier Street, Wandsworth, we've owned for a very long time. In the last 12 months, we've been busy refurbishing and setting record rents. We're now, latest tenants are paying in the mid 50s, £55 per foot on a refurbished units, all ESG friendly, solar panels, etc. But that is your ultimate, small units of urban regeneration. And then Cambridge, our most recent purchase. This is a building let to Marshalls, who are an aerospace contractor. They've just sold Cambridge Airport to Homes for England and a residential developer. This is a building which they're currently in, but we think they don't need to be in it for very much longer, and we hope to do a deal with them, take the building back and re-let it to somebody else. But if they want to stay in there for the next 9 years, they can, and we're clipping a 10% coupon on that. So we bought that building off a 10% yield. Okay, I'm on the 11:30 mark, so we'll just whistle through some of these bullet points, much of which we've talked about, but I think it's really important. Fundamentals remain positive, low levels of construction. Cost inflation has been huge, 35-40%. in the last 3 or 4 years. I mean, really dramatic. You know, your development appraisal, if you were thinking about building, just went out the window, or you've had to renegotiate to buy the land. So land values have come down. The undersupply of prime space we've talked about. Um, the upward movement in the shape of the curve, yes, we've talked about that, but margin spreads have not widened. And you know, real estate prices have corrected very dramatically, and I think that's you know, and trade very at a very under demanding levels. Um, you know, obviously we've had the shock of another war breaking out, but I think it is important not to try and draw too many parallels with March 22, because we were coming off a very different place in terms of the cost of capital, the price of money at the time. We're a much higher starting point. Um, and then, of course, the AI narrative will once again return to the forefront of investors' minds, not least with the forthcoming IPOs in the States. And you know, we reinforce the fact that halo assets are, you know, we think will lead to outperformance in 26. You know, this is heavy asset, low obsolescence, and I think that's something that's, you know, we should bear in mind. We know we're not SaaS. We're not going to get damaged by that. And then finally, if everything remains as cheap as it is now, then there will be more M&A activity. And yeah, we've seen activism, you know, in a number of places, number of quarters. Anyway, I think at that point, having it's a real whistle stop, so I'll hand back to Alan.
Thanks, Marcus. Reading through the questions, there's a few strands that around different countries, and so I'm going to try and wrap that up and say, you know, in some way, obviously, TL Property, the clue's in the name, but in some ways, it's a European specialist equity fund, and for the first time in ages, park the UK for the time being. There's some positive signals in European economies. Germany is the one that everybody is very focused on with its spending plans for infrastructure, but you've got arguably finally some recovery from the financial crisis for more southern European countries, and so Spain has had a very successful time in the banking sector, and you referenced Poland. So do you want to talk a little bit about some specific countries that you think look interesting right now, and then maybe talk about what worries you and how you manage country risks?
Yeah, great set of questions. So let's start with Southern Europe, and in many respects, they are the success story of the last couple of years. And you know, our exposure in Spain is primarily through Merlin, which is a diversified Soshimi, which is a Spanish REIT. But it has been very smart over the last 5 years in developing its data center growth plan, and is really at the forefront of building out data centers in the markets where you know, essentially energy is the cheapest in Europe. And that's been, you know, that's certainly been an important part of the outperformance of Merlin. As you say, the economy is doing well, and when that happens, we do try to get exposure to um, the consumer and consumer spending. So shopping centres are important, and we have exposure through not only Unibail but also Kepler. Our office exposure was reduced because Arima, our little business that we backed at IPO, was taken private 18 months ago, and we were disappointed to see it go, because we could see that Madrid office market really coming back fast. So the buyer did a very good job. We made a 20% plus bump on the day, but it was, we lost the company. Unfortunately, the only play on the office markets of Spain is a business called Colonial, which is a real mess, and in our view, very, very poorly managed, and has some very unorthodox accounting treatments, which we're not entirely comfortable with. Not illegal, but they're just not what we think is appropriate. In terms of Italy, very much focused on the north. Lombardy is the richest region of Europe, doing incredibly well. We have great exposure through Euro Commercial, own 7 shopping centres in the region. So very, very happy with that. Coming further north, we mentioned Poland and TAG, and that they, of course, are super, sort of super enhancing their economy with defence spending. And of course, that's what we're now seeing in Germany. And to be blunt, this is critical to the German economy, because it's not just about munitions. This is actually about infrastructure, and they really, the great thing for the German economy is it's been very, very well and carefully managed, and they absolutely have the ability. They have very little deficit to get out there and spend money. And our exposure through Sirius, one of the very few REITs trading pretty close to its asset value, is very much reflecting our desire to get more exposure to workspace, be it light industrial, heavy industrial, logistics, etc. Less keen to own offices. There's a bit of oversupply outside of Berlin. There's a bit of oversupply in Frankfurt, Munich, Hamburg. We're less keen on those markets. Berlin is going great guns, and we have that exposure to residential markets. There is a risk coming from the left-wing government of the state of Berlin, where there is still mutterings about expropriation style, and we think that we maintain our ownership of Phoenix P. Deutschland, because it's has only inverted commas about 2,000 apartments, and they seem to be these left-leaning bodies appear to be focused on the much larger businesses like Deutsche Wohnen, which is part of Vonovia. So that is another risk factor to not owning Vonovia. And then elsewhere in Eastern Europe, we have really seen, it's fascinating, the response of tariffs and issues around global trade routes. We're seeing a lot of nearshoring, onshoring, a lot of Asian businesses bringing final steps of production or just parts of their production chain and supply chain closer to their end market. So a business called CTP, which is the biggest developer of logistics and warehousing space across all of the Eastern European countries. We've been big beneficiaries of that trade. So that's a sort of bit of a country summary. I mean, France remains tricky. It's tricky because it has clearly issues with the government. We've got more elections next year. There is further strike action planned. But having said that, prime Paris is a little bit like prime London, or prime Madrid or Milan. It's doing really well. There is very much we're all very much back working from the office at least the majority of the week, generally 4 and 1 or 3 and 2, but there is very much an understanding that people want to do business face to face, and more importantly, if you want to get your staff back into the office, it needs to be a decent working environment for them. And on a day like today, wherever you are in the UK, you almost certainly want to be in your air-conditioned office, not at home, sweltering from the spare room or wherever. And that's, we very much see this for example, in Southern Europe, where people don't want to work from. I mean, quite literally, the summer it's, why pay for your air conditioning when your employer will happily pay for it, so you'll go to the office. Same way in the northern hemisphere, or in the northern countries, we see the same demand for office space in the likes of Stockholm. People go to work rather than heat their homes all day long in deep winter. Have I covered
Yeah,
the question?
you have, and you've studiously avoided commenting on the UK, and maybe that was deliberate,
No,
given
no.
given that it's.
Yeah. Well, let's finish on the. I mean, yes. We should go to the UK, because clearly the gilt market is moving around a lot, and I think it all hinges on who he appoints as chancellor. It's either going to be a competition or a coronation, but either way, you could argue there's some instability for a while. But I think he cannot be immune, if it is Burnham, to the fact that this country is singularly failing to execute infrastructure projects that are badly needed, or they're just total cost failures like HS2. But we have had successes. I mean, Thames Tideway, which is the super sewer underneath London, was built on time and on budget. So we can do it. It's just got to be structured properly. But there's, in some respects, the real estate industry has high hopes for, if he does reassure the bond markets about maintaining fiscal rules, but he also appreciates that we are going to have to spend money on defense, on infrastructure, on physical fabric, which needs repair. Then he's going to have to make some difficult decisions on where the money comes from. But it is, I think one would argue, his experience of growing, of how the the spend in the Manchester conurbation was really much a factor of building a lot more residential. And I think that's a theme that we will come back to. And the way to get that moving is to just accept that you can't have that much social housing built on site. It has to be built somewhere else, because because developers just won't give up their very small parts of of this expensive land, and to put social housing in a central location.
Mm. So overall, various positives across Europe. UK has a lot to play for. Might be the summary there. And just mindful of time, I wanted to wrap up by just asking you if you could join some dots, because as I mentioned at the beginning, TL Property's got a very long track record of increasing the dividends. And as you well know, revenue growth slowed. Investment Trust carried on growing its dividend. In the last financial year, growth was really strong, and there's a kind of hangover from dividends being reduced or suspended, isn't there, from COVID, and has the catch up now completed in your mind, and are we now in a sort of phase where earnings growth and dividend growth in the underlying property sector is back to being the key driver?
Absolutely. With one however. So we are definitely seeing top line growth in pretty well all our markets, as I've the ones I've certainly mentioned. The exceptions being in secondary offices, some of the secondary retail where they've struggled too many retailers have gone to the wall, etc. However, is that we are still dealing with a little bit of refinancing risk. So you've got businesses that have still have 2020, 2021, 22 debt vintages that are now rolling off or require refinancing, and that is leading in some cases to higher well, they are higher interest costs. So you've got your top line growth, and but unfortunately, the cost of your debt is eating into some of that. Now, not everywhere, excuse me, not everywhere. And more importantly, that is itself also running off. Every company is fully aware of it. Every company is flagging it. And we are absolutely, as you can imagine, mapping all of our expected cost of capital for each company, judging by its refinancing requirements and needs looking forward. So I think that's very much in the price, not unexpected, not unexpected. And that really shows you, and for us, it's we can choose to avoid some of those ex-growth names if we think it's going to take a long time to come back. But I would re-emphasize the fact that the board quite deliberately are maintaining, they feel confident about maintaining growth in the dividend at the trust level, even though our earnings, we saw that 20% recovery last year. We will see further recovery, which will take us, back into positive territory in terms of our revenue per share relative to our dividends. And then I suspect the board will do what I've done in previous cycles, is your payout ratio becomes 97, 98% rather than 100, 203. So, but I'm fully optimistic that and part of anything else, no one's the cost of construction has gone up so much that no one's going to build these buildings unless they're confident of setting these new headline record rents, because it's you just so it becomes a very much a self-regulating environment. And then of course across the whole of Europe we have indexation in one form or another, so we're very much picking that up. But I think for me, in some respects, it's encouraging that we're seeing some real slowdown in inflationary pressures in Europe. And we've had numbers from Germany today, numbers from France yesterday, which are very much pointing to, and that started to be, you saw the 10-year Bund has dropped a few bips today. I think that's going to be a feature. These, and the UK. I mean, I know the politicians keep banging on about the one quarter we were the best in the G7. Well, it's in the land of the blind, the one-eyed man, and all that. But the fact of the matter is that's not how it feels out there. And sure enough, numbers this morning would point to that. So businesses are not necessarily expanding. So again, the point for us, I'm not being some crazy optimist. I'm just suggesting that we very much focus making sure we don't have too much exposure to a lot of SMEs that we think are possibly at risk. We look very carefully at the underlying strength and quality of the income we're invested in. But a point I would reinforce is that when you look at all listed real estate companies, our average loan to value is mid 34, 35%. I mean, this is, every deeply indebted private equity property fund would kill to have that little leverage. And that's just because public markets just won't, they're just like, we're in the backseat of the taxi. We're not going to be happy when you jam this thing into overdrive with 45% LTV. So yeah, we're cautious Cuthberts. We want safety. So there is some room for that as well. And some companies are feeling the uptick and they are going up there to slightly higher leverage, but it's earnings enhancing, and that's the important thing.
So overall, property back to fundamentals. Income is the most important factor over the long term, I think, is the message. And I think with that we've run over time. Marcus, I think we should arrange to put an amended version of the slides with the missing slide available for download. Everyone who's attending will get a notification when that goes up, and they can have a look at that. And obviously this is recorded, so as people viewing it later will be able to have that slide in front while Marcus is describing it. Marcus, thank you so much for your time and
Thanks,
enthusiasm.
Alan, and thank you, everybody.
Yeah, thanks everyone for attending, and we'll see you on the next one.
Goodbye.